Hi, I'm Gemma Dale from nabtrade. End of financial year is a fantastic time to consider your portfolio and make those special deductions and expenses you may want to do before the 30th of June. It's worth remembering that this year the 30th of June falls on a Saturday, so anything that you would need to prepare during business hours, you'll need to complete by close of business on Friday the 29th. One of the first things you can do is have a look at your portfolio. Have a look at how it's performed, any outstanding stocks or issues that you may want to resolve. You can carry forward losses from previous years and potentially offset them against gains this particular year, and think about whether or not it's a good time to reposition your portfolio for growth or for income in the coming year. End of financial year is also a fantastic time to think about whether or not there are expenses that you can claim a deduction for. If you make these towards the end of the financial year, then you may get a benefit very shortly afterwards when you put in your tax return. The instant asset tax write-off of up to $20,000 for those who are small business owners or self-employed has been continued this financial year and next financial year, so it was very popular. One of the budget announcements from 2015, in fact, it was only supposed to be a one-year event. It has continued. If you have any expenses up to that $20,000 amount, there are certainly stocks that benefit from people who are using that as well, like JB Hi-Fi and Harvey Norman, people buying business equipment and so on. So you may think about using that if you are self-employed. In addition, you can think about those other expenses that are deductible. So anything related to your work, the ATO has fantastic information on its website that will help you understand whether or not something's deductible as it relates to your profession or your employment, subscriptions, for example. And the other one that many people do think about this time of year is income protection. So income protection insurance is deductible at any time of year, but if you prepay a full year's worth of premium, you can claim a deduction in this year's financial tax return. We always love to talk about superannuation at this time of year, and this year there is a fairly dramatic change which will impact many numbers of people. For those who are self-employed, you've always been able to make a contribution and claim a deduction for that in your tax return, so long as you met the other contribution requirements. For those who are employed, so you got more than 10% of your income from an employer, you were only able to really salary sacrifice as a way of getting a personal deduction for your contributions. This year, the level playing field has come into effect for the very first time. So both employed and self-employed people, so long as they're under 65 or meet the work test up to 75, can contribute to superannuation and claim a deduction. Now, you've got a $25,000 a year cap, the concessional contribution cap, and that applies whether you're claiming a deduction, it's an employer contribution, or it's a salary sacrifice contribution. So make sure that all of the amounts you can contribute and that you claim a deduction for, or your employer claims a deduction for, are within that $25,000 amount. There are a few things to remember with this, and because everyone's going to be going through it for the first time, you need to think about these things. There is a notice of intent to claim a deduction that you have to submit. So that needs to go into your funds before you submit your tax return, and before a couple of other things that you might want to do, like splitting to your spouse or starting a pension or rolling over those funds. So make sure you get that form in. Probably worth speaking to your fund before you make the contribution, see how much your employer has contributed, work out the amount, and ask them for a form at the same time, so you make sure you get the process right. But fantastic opportunity for people to boost their super and make some savings on their tax at the same time. For those who are in pension phase, it's absolutely critical that by the end of the financial year you have paid out the pension minimum. This is generally not relevant if you're in a public offer fund. Large funds will manage that process for you and ensure you've taken the minimum amount. But if you have a self-managed super fund, you are going to have to make sure you do that yourself. Have a chat to your administrator or your accountant. Ensure that you know exactly how much needs to be taken. Maybe take a little bit more just to be on the safe side, and ensure that you've got that full amount out of the fund by the end of the financial year and the payment has been made. The reason that matters is that if your fund has not taken the full minimum amount for the year, the fund will be treated as if it was in accumulation phase, not pension phase, and you lose that tax-free benefit of the amount that you have in pension. Finally, a couple of other superannuation benefits that are really worth thinking about, and if you can layer these on top of each other, it's even more attractive. One is the co-contribution, which has been around for many years. It's changed a little bit over the years. Always worth taking advantage of though. So if you earn below $36,000 a year, you can make a contribution of up to $1,000 and receive a co-contribution from the government of $500. It's an after-tax contribution to your fund. It's a 50% guaranteed return. You'd be mad not to take advantage of it. And finally, the spouse rebate is one we haven't talked about a lot. So the spouse rebate was available where you have a low income earning spouse. You can make an after-tax contribution on their behalf and receive a rebate of up to $540. Now, low income earning used to be very low income earning, less than around $13,800 to get any form of rebate. Now that has been increased to $40,000, so it's a pretty dramatic increase. If your spouse is earning less than $40,000 a year, you can make a contribution on their behalf and receive that $540 rebate, not into their fund, but in your tax return. So that one's quite attractive, gives you an opportunity to boost your spouse's superannuation and to receive a rebate in your own name as well. So you think about this from a family perspective, contributions that you may be able to claim a deduction for, very attractive, contributions you may be able to make for your spouse, and then potentially co-contributions for your children as well. If you're a bit older and you have perhaps wound back your working hours, you might like to take advantage of co-contribution for yourself as well. We've put some tips up on our website for you, printed out so you can have a look at some of the things you might like to consider. Speak to your accountant, your administrator, or potentially your financial planner. Make sure you get all of your paperwork done before the 30th of June or preferably by the 29th, and think about all the things that you can take advantage of to ensure that you've optimised your position before the 30th of June. Thanks for watching.